This is Steve Young for the Code Roundtable. I'm sure most of you have heard of the three letters, ESG, Environment, Society, and Governance, and you're probably aware that there are a number of investment funds which buy stocks in companies which have high ESG scores or ratings, or they're supposed to be better at delivering ESG public goods than other companies. However, one of the very large investment funds in the United States, Vanguard, one of the first, has pulled out of a group of companies which have promised to invest only in companies with high, good ESG scores. And one of those groups is the Net Zero Asset Managers Initiative, which has managers of funds of $59 trillion, which are going to commit to ESG only. And there's also the United Nations affiliated Glasgow Financial Alliance for Net Zero carbon emissions, which has $150 trillion of managed assets committed to putting in companies which will have net zero greenhouse gas emissions by 2050. Now, the CEO of Vanguard made the point that if you do an ESG strategy, you're picking certain companies, whereas the history of returns over, I think Vanguard was started in the 1960s or something like that. So we're looking at 60 years of data that investment firms which broadly diversify, in other words, they put a little bit of money in many companies in different industries. That diversification strategy, this is stocks, equity investments, over time brings higher returns than if you pick your grandmother's favorite company or your favorite company, or you decide to put your money into cryptocurrency and you pick the wrong one, or something happens. The point is that diversifying your risk increases your returns over time. And the Vanguard CEO pointed out that fewer than 1 in 7 active equity managers, financial advisors who will help you place your money, outperform the broad market in any 5-year period. If a 10-year period, it's only 1 in 10 advisors can outperform. And if you look at a 20-year period, it's only 1 in 20 advisors. So that means that if you are moved by some preference, some value preference, ESG or whatever it might be, you might be riding with the market or you might be going against the market. Now, some other people looking at the same issue around ESG, they took some data as to which companies, this is more on the political side, companies that sort of were measured for their political points of view in America, for liberal on one side, conservative on the other, and non-political in the middle. And so all these companies were scored for their political orientations, which is things like, woke capitalism, various things, environment, education, abortion, Second Amendment gun rights, other basic constitutional freedoms, and support for a safe civil society. It turns out that the companies in the middle, neither left nor right, had higher returns. That companies with either low scores or high scores had lower returns, which is telling us something about the sort of central dynamic of a market, which doesn't particularly reward either opinions or particular causes like ESG. It's rewarding something that has to do with returns and money. And while that may seem greedy, and it probably is, it is reflecting something about how we can create wealth. Because we need to create wealth first, and then we have to address the difficult problem of how do we cut up the pie.